If you're heading into a busy summer season, here's something that nobody warns you about. More sales can actually be a big problem. And I mean a big cash flow problem. Sounds ridiculous, right? More work, more customers, more invoices, more revenue should be coming in. Sounds great. Except now you have more payroll, more inventory, more materials, more vendor bills, more costs, and probably at least one expense that shows up acting like it owns the place. This is where business owners get squeezed, not because the business is failing, because the money going out and the money coming in are not on the same schedule. So today we're gonna go over 5 things you're gonna need to check before you go into your busy summer season that could drain your cash flow.
And this is important because a lot of owners don't realize they have a cash flow issue until they're already reacting to it. By then, the options usually get worse. The goal is to see the pressure before it becomes urgent.
Exactly, because the worst time to figure it all out is when payroll is due, inventory is low, and your bank account is like, good luck, pal. So let's get right into it.
Numero uno, don't confuse booked work with money in the bank. Booked work, invoiced work, and collected cash are 3 very different things. Booked work means someone agreed to move forward. Invoiced work means you sent the bill. Collected cash means the money is actually sitting in your account. And for cash flow, that last one is what matters.
Right. You know, most business owners say, don't worry, I got $200,000 worth of work lined up. Well, that's great, but how much of that is actually collected? How much of that is actually invoiced? How much is still waiting on the customer, the project timeline, the insurance company, general contractor who's still using a fax machine like it's 1981? That difference matters because you can't pay your team with money coming in soon. That's not a currency. I wish it was, but unfortunately, it's not.
The takeaway is simple. Look at what's booked, what's invoiced, and what's actually collected. If too much of your revenue is sitting in the coming soon column, that's where cash pressure can start.
Number 2, map out the next 30, 60, and 90 days. And I mean, actually sit down and map it out, not just in your head. Write down what is due: payroll, rent, materials, insurance, taxes, vendor bills, debt, equipment repairs, marketing. Sounds like a lot? Because it is. Write down whatever is coming. Then put dates next to each one because the date is usually where the problem hides.
Then do the very same thing with incoming cash. What payments are expected, when are they expected, and how confident are you they'll arrive on time? This is where owners usually start to see the issue. The expenses are fixed. The revenue may be expected and fluctuating, but expected money and available money are not the same thing.
Exactly. Once it's on paper, you'll stop guessing. Maybe everything's fine. Great. Or maybe there's just a small hurdle that you need to overcome. No problem. Or just maybe July is loading up a financial haymaker. Either way, you'll know right before it connects.
Number 3, know the upfront costs of growth. Growth usually costs money before it produces money. That's the part people underestimate. If you're taking on more work, you may need more labor. If you're selling more product, you may need more inventory. If you're starting bigger projects, you may need materials, permits, deposits, equipment, or subcontractors before you get paid.
And this is where great news becomes a huge problem. A contractor gets a bigger job. Great, now they need materials. They need labor before their first payment even comes in. A restaurant, on the other hand, expects a really strong summer. Great, they need food, they need staff, supplies, repairs, maybe even an outdoor setup. All before the profits show up. Listen, that's not failure. It's just a cash timing issue.
Exactly. So ask yourself, what do we have to pay before the revenue even comes in? That matters because if you don't know the upfront costs, you don't really know whether the opportunity is funded properly.
And that leads us to number 4, stress test late payments. Nobody likes this one because it forces you to imagine customers are going to pay late. And look, I know it's difficult because we all know
customers always pay on time.
Now, let's get back to real life. Ask yourself, what happens if your largest customer's invoice is 15 days late? Then step back and ask again, what happens if their invoice comes in 30 days late? What happens if 2 customers are late in the same month? Can you cover payroll? Can you still buy materials? Can you still make your debt payments?
Receivables are important, but they're not cash until they're collected. If one late payment can create a serious problem, you need to know that ahead of time. That doesn't mean panic, it means planning. Maybe you tighten collections, maybe you ask for deposits earlier, maybe you adjust your payment terms with your clients. Perhaps you need a funding option in place before the pressure hits. The point is to find the weak spot while you still have choices.
Exactly, because once you're desperate, every offer starts to look a little bit better than it should. That's how business owners end up signing deals they would have questioned if they just had a little bit more time.
Number 5, match the funding to the actual problem. This is where a lot of business owners get pushed in the wrong direction. They say, I need money, but that's not specific enough. The better question is, what is the money supposed to accomplish?
Right, and before you even start to talk about loan amounts, interest rates, and approvals, you really have to understand what problem you're solving for. Is it a timing issue? Is it an equipment issue? Is it a bigger project? Is it working capital for a short-term push? Those are not the same conversation. A line of credit may help with timing. Equipment financing may make sense for equipment. A project may need structure that lines up when you actually get paid. That's the part that a lot of business owners miss. And frankly, that's the part that lenders completely skip. They go straight to the offer. We go straight to the reason.
Why? Because the reason drives the structure. The payment amount, the terms, the timing, it all matters. And the repayment schedule has to make sense for how cash actually moves through the business. That's why the wrong approval can still be a problem. If you borrow too little, you may not fix the gap. If you borrow too much, you may take on payments you didn't need.
Exactly. The goal isn't just to get approved. The goal is to get the right capital for the right reason with the right payment structure that the business can actually live with. Again, it's really wild stuff.
So if you're heading into a busy season, don't just look at the sales numbers. Look at timing. What's booked? What's collected? What has to be paid before the money comes in? Where could late payments create pressure? And if you do need funding, make sure the structure actually matches the need. If this was helpful, subscribe to the Credit Bank YouTube channel. We'll keep breaking down the funding questions business owners should understand before the offers start hitting their inbox. And drop a comment below. What's putting the most pressure on your cash flow right now? Payroll, inventory, materials, slow paying customers, a project that looks profitable but is eating cash up front. If you're looking at the next few months thinking we may need capital, don't wait until it becomes an emergency. Book a call using the link in the description or text the number you see on the screen. Our team over here at Credit Bank would love to help you out. Enjoy the summer. See you next time.